In our previous session, we discussed valuation of bonds. Today, we are going to explore a new topic, and that is bond yield. In this unit, we will explore how investors evaluate bonds, how yield impacts their decisions, and the intricate relationship between a bond's price and its returns. Imagine two bonds. One offers a high coupon rate but is priced at a premium, while the other has a lower coupon rate but trades at a discount. Which one should you invest in to maximize your return? To answer this, you need to understand yield concepts like current yield and yield to maturity. By the end of this unit, you will be able to confidently tackle such scenarios. At the end of this topic, you will be able to comprehend the meaning and significance of bond yield. You'll also be able to learn the formula and process to calculate YTM. You'll be able to explore bond value theorems. Think of bonds as an agreement between the borrower and the lender, where the borrower pays back the principal along with the periodic interest. But how do investors determine whether they are getting a good return on their investment? That's where the concept of yield comes in. Bond yield is not just about the interest payments, it's a reflection of the bond's price, the time left to maturity, and the risks involved. Understanding bond yield helps investors make smarter decisions and assess whether a bond is worth its price. In this session, we'll discuss various concepts like assessing the returns from a bond and interaction between a bond's price and its yield. Let us now understand the bond yield measures. The bond yield measures are categorized into two parts. They are current yield and the yield to maturity. Let's begin our discussion on the current yield, a fundamental concept that helps investors quickly assess the return of a bond offers relative to its market price. This measure is especially useful when bond prices fluctuate in the market. Current yield is defined as the annual coupon interest earned on a bond divided by its current market price. The annual coupon payment is the fixed interest paid by the bond, calculated as the face value multiplied by the coupon rate. It's important to understand that the coupon rate and the current yield are not the same. The coupon rate is fixed and calculated based on the bond's face value. The current yield, however, depends on the bond's market price, which can vary. So if the market price of the bond equal its face value, the coupon rate and the current yield will be the same. However, if the bond trades at a premium or a discount, the current yield will differ. Imagine a bond with a face value of rupees 1000, a coupon rate of 8%, annual coupon payment is equals to rupees 80, a market price of rupees 900. Using the formula of a current yield, that is coupon interest divided by current market price, we get 80 divided by 900. On simplification, we get 0.0889 or 8.89%. This shows that if you buy the bond at rupees 900, the return you earn based on the coupon payment will be 8.89%, which is higher than the coupon rate because the bond is priced at a discount. If you have ever wondered how investors measure the total return they will get from holding a bond until maturity, yield to maturity is the answer. It's more than just a percentage, it's a tool that helps investors evaluate risk, compare bonds, and make informed investment decisions. Yield to maturity rate of return earned by an investor who purchases a bond and holds it until it matures. Essentially, it's the discount rate that makes the present value of all the future cash flows, coupon payments, and principal repayment equal to the bond's current market price. The rate of return, which is KD, which makes the discounted value of these cash flow equal to the bond's market value, is known as YTM of the bond. Now let us discuss the key characteristics of YTM. YTM as the internal rate of return, IRR. YTM is often referred to as the IRR for a bond. Like IRR in capital budgeting, it's the rate that equates the present value of cash inflows to the initial investment. Here the market price of the bond. YTM assumes reinvestment of interest payments. A fundamental assumption when calculating YTM is that all coupon payments are reinvested at the same YTM rate. This means the actual return could differ if reinvestment happens at a different rate. YTM changes with the market conditions. The YTM of a bond is not fixed over its lifetime. It fluctuates with changes in the bond's market price. If the price of a bond rises, its YTM falls and vice versa. YTM equals coupon rate for par bonds. For a bond trading at par value, the YTM will match the coupon rate. For bonds trading at a discount or premium, the YTM adjusts accordingly. We'll use the bond valuation formula to calculate the YTM. The formula for calculating YTM is complex because it requires solving for the discount rate, which balances the present value of the future cash flows with the bond's current market price. Here's how it works. First, determine cash flows, which is identify the periodic coupon payments and the face value repayment at maturity. Second, discount future cash flows. Use the YTM as the discount rate to calculate the present value of these cash flows. Third, equate to the market price. Adjust the YTM until the sum of discounted cash flows equals the bond's current market price. Fourth, trial and error calculation. This adjustment is based on the trial and error method. For example, let's say you have a bond with the following details. Its face value is rupees 1000 and it matures in 9 years. The bond is currently trading in the market for rupees 850. It pays an annual interest at a rate of 8%. Now here's the big question. What is the rate of return you would earn if you buy this bond today and hold it until the maturity? To calculate, we will use the bond valuation method. The trial and error method to obtain the rate of return, which is KD, is a very tedious procedure and requires a lot of time. The following formula can be used as a ready reference formula. The yield to maturity or YTM is equal to the sum of annual interest represented by I plus the difference between the face value, which is F, and the purchase price, which is P, divided by the number of years to maturity, N. This entire expression is divided by the average of the face value F and the purchase price P, which is represented as the sum of F and P divided by 2. Let us take a simple example for approximation method. Suppose a company issues a bond with a face value of rupees 5,000. It is currently trading at rupees 4,500. The interest rate offered by the company is 12%, and the bond has a maturity period of 8 years. We have to calculate YTM. To solve, we will use the approximation formula. Here, F is equals to 5,000, I is equals to 12% of 5,000, that is 600, P is equals to 4,500, and N is equals to 8. Substituting these values in the formula, we get 600 plus, inside the bracket, 5,000 minus 4,500 divided by 8, close the bracket, divided by 5,000 plus 4,500 inside the bracket divided by 2. Upon simplification, we get YTM as 0.1394 or 13.94%. To follow factors affect the bond value theorems, relationship between the required rate of return, which is KG, and the coupon rate, numbers of years to maturity, yield to maturity, YTM. We will look at the theorems under each circumstance as mentioned in greater detail over next slides. Following are the theorems which show the effect on the bond values influenced by the relationship between required rate of return, KD, and coupon rate. When the required rate of return is equal to coupon rate, the value of the bond is equal to its par value. When the required rate of return is lesser than the coupon rate, the intrinsic value of the bond is greater than its face value. Let us now explore how the relationship between the required rate of return and the coupon rate impacts bond valuation over time. As the bond approaches maturity, we will analyze two cases. When required rate of return is greater than the coupon rate, when the required rate of return is greater than the bond's coupon rate, the bond is said to be trading at a discount. As the bond approaches its maturity, the discount reduces and the bond's value moves closer to its face value. When required rate of return is less than the coupon rate, the bond's coupon rate, the bond is said to be trading at a premium. As the bond approaches its maturity, the bond value moves closer to its face value. A bond's price varies inversely with yield. This is because as the required yield increases, the present value of the cash flow decreases and hence the price decreases. For a given difference between YTM and coupon rate of the bonds, the longer the term of maturity, the greater will be the change in price with change in YTM. Thus, long-term bonds are more variable to changes in interest rates than the short-term bonds. Given the maturity, the changes in the price of the bond will be greater with a decrease in the bonds YTM than the changes in price of bond with an equal increase in the bonds YTM. For any given change in YTM, the percentage price change in case of bonds of high coupon rate will be smaller than in the case of bonds of low coupon rate, other things being constant. In this session, we have learned the meaning and significance of bond yield, including current yield and yield to maturity, which is often termed as YTM. We have learned the formula and process to calculate YTM using trial and error and approximation methods. We have learned to analyze the relationship between bond price, yield, and interest rates. That's all for today. Thank you and happy learning.